Hello and welcome, What the Finance, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Alexander Campbell, who's the founder of Rose.ai and former global macro investor at Bridgewater and Lehman. So, Alex, thanks for joining the podcast today.
Oh, thanks very much for having me.
You're welcome. So, I guess my first question, you talk a lot about China, and I guess that's potentially due to your commodity past. But, what really drew you into analyzing China? And I guess why does it matter from your opinion?
I think it started with being a data guy, actually, partially because it's so interesting and this like existential question of like, can you trust the numbers? But then you can trust when you're in commodities, you can trust like seeing the demand and where it's going. And so that was kind of what led me to look at the financial system because you look at, okay, how are these companies financing all this commodity consumption and production? And as you go and look at different production systems or cost curves or whatever you want to call it, you find in a lot of cases a ton of capacity that was looked uneconomic. And so that was kind of how I got onto the banks. I was a banks guy at Lehman, and I did some banks and financials work, in pure global macro. But it was kind of the synthesis of those two areas where if you just look at the banks, you go, okay, these mortgages are going out there, these corporate loans are going out there. You don't really know they're going. If you're just looking at commodities, you're saying like, oh, like they consume a lot of commodities. But I just think because I was at the nexus of both of those things, banks and commodities, I would go, okay, well, how are they paying for the commodities? Wait, does any of this make sense? And then that leads you to like the money supply numbers and the, WMPs and all that stuff. And it was just, seeing a chart of US money supply versus Chinese money supply and just saying, oh, wait, you're telling me there's twice as much money in China right now on today's exchange rate. And being like, I think that would make sense in like maybe 50 years or 100 years for sure. But right now, what that meant to me was that they were much more on the Japan track than most people thought. That meant tons of debt. That meant tons of deflation and, kind of flat income growth for a long time afterwards or else. And so that was kind of the trade-off that I thought was very interesting as an investor and also as like a data person, because then you break out your tools and your approach and you say, okay, can I figure that out? How would I go learn about that?
Yeah, it's really interesting. And I guess, um, sort of as you mentioned there, it's very similar to Japan, I guess, what we saw in the 70s and 80s. So I've heard you talk about this before, but do you see it becoming the next Japan where, there's a massive crash, I guess, in the late 80s, massive real estate crash as well as asset bubble crash. And then from there, we've just seen probably deflation for the past 30 years.
Well, most of the bullish narratives, aside from just runaway 6% income growth that has nothing to do with property, which is kind of a ha-ha now, but most of the bullish narratives on what's happening in the Chinese debt system are that it will look like Japan, that it will eventually follow that path. And the thing that doesn't hold up to scrutiny there to me is one, Japan had an open capital account for about 10, I think like 20 years before they raised interest rates and popped the bubble. And that meant that there was 20 years, 10 years of wealth that had left the country that came home. The yen goes up on the deleveraging in that scenario. Whereas in China, you've had a closed capital account. And when you have pain in the banks and pain in the system, the money leaves because the balance of pressure is to go out as opposed to come in. And to me, that's a very different scenario, and maybe why it feels more existential for them not to prick the bubble. I don't know. I think there's also like a way more explicit deal between the people and the government, at least under my, whatever foggy view of like 5%, 6% used to be 8%, GDP growth or whatever. And when you take away that deal, it just changes. And the way that people were monetizing that deal, the way that they felt that benefit was property, was wealth, wasn't the stock market. And so if you really say, okay, now imagine what happens if you take all those Evergrande lots, not even the ones that aren't finished, the ones that just got bought as speculative, mark them down by like a third, 50%. There's a lot of people who are, that they're not that happy. And so I think that combined with the COVID stuff was why we saw the turnaround in policy, actually, which is good for the world. It sucks that people are getting sick, obviously, but it's good for the world that there is some responsiveness to what people want and people need. And I think it was a combination of property and the COVID thing that was like, look, you can't have both. You can't prick the property bubble and lock everyone down and do a crackdown on the protesters explicitly, because you've broken that old deal about you're going to get rich in exchange for not being able to tweet or whatever. And so now they're trying to readjust that deal. I don't know how that deal is going to go down. That's their decision, not mine. But I like watching it and tracking it and trying to understand it.
Yeah, it's super interesting. So if we go back a step and look at, you mentioned like looking at data that comes out from China, I guess there's concern that maybe it's not as trustworthy or maybe the numbers are, massage. What's your opinion on that from analyzing it for this period of time?
Yeah, so I am so interested in this question. I started a company to try to help people find data, look at it, see it, buy it, robots to help you do all this stuff, generative AI, woo, like that whole thread. Because there's a truth that I think I saw a little bit from working in these different financial institutions and then working at Bridgewater, which I think is like the best data people in the world probably, is that there's no such thing as pure truth. It's like there's like PCE CPI and then PCE inflation, and there's CPI inflation, and there's urban, and there's X food and X energy and X clothes and X, the VAT tax in the UK and the Japan, income rebate or whatever. And you start getting into the details and you realize that it's all just humans trying to understand how these machines work, and is it going up and is it going down and how fast and how does that compare to history, and should I care or whatever. And so I think about it as like asymptotically approaching truth, which is such a cheesy way to think about it, but it's like there's no such thing as truth, but you can get closer and closer and closer through lots of different points of feedback and information. And maybe US inflation numbers aren't as accurate as they could be because we're doing owner adjusted rent wrong or whatever, but they're 80% closer to truth, and maybe the Chinese fixed asset investment provincial stats are 40% correlated to truth. It means that you have to just know that when you're looking at it, and then adjust your confidence and how you do math about that stuff in a weird way, because you say, wait a sec, like use it, but don't trust it so much, but then understand how it breaks. And it's funny because like one of the best signals that happened in the world was super simple in COVID, which was the Chinese PMIs just got destroyed in like February 2020 or whatever, because they were locking everything down, and they were locking everything down before everybody else even knew it was a problem. And it was like, you got this, they had these super managed PMIs. It was like, I don't know the numbers, but like 55, 56, 56, 60, 68, like 57. And then it was like 35. And it was like so bad that you had to be like, whoa, what's going on, right? And like that was in a funny way, and I'll just finish this ramble at this point, but like a preview of what was going to happen with oil 2 months later, right? Because how many people in their spreadsheets had oil ever going negative? Nobody ever had oil going negative. And then you go, oh, second month future, third month future, 6 month future, what's the price of oil? You do a PhD thesis on that, but there's no price of oil, right? There's just a bunch of different futures. And some of them in April went negative, and a bunch of people got their faces ripped off because they didn't think that could happen. And now what do you put in for the price of oil in April 2020? Like you have to go make a decision, and there's no perfect decision. Someone's going to put it at zero. Someone's going to use the negative. Someone's going to say, oh, I look at the third month future. And as soon as you acknowledge that there's different kinds of truths and different lenses on truth, it becomes a counting game, really, where it's just, okay, go find all the different measures of truth, test them, aggregate them, look at them, and then you can look at something like China and still read it, but not get fooled into thinking that you know more than you do.
What are the key, I guess, indicators that you're watching in terms of where you see, because I guess we're seeing the China opening up now. Are you seeing sort of any impact in the data currently, or is it too early?
Yeah, I'm pretty open on Twitter about this, so I'll just make sure my numbers are right here. But I had two indicators for what was going on in lockdown that I think are still good, and one is this ETF of Chinese property bonds, and these are dollar property bonds. But these are companies that have all now clearly gone under or distressed, or the whole sector is basically trading totally distressed. And you can track, like, are the bonds going from 8 to 20 to 25 to 40, and they're all these like really low numbers. And the ETF went from like trading in Hong Kong 3001 HK, it went from like 350 to like 70, down like 70%, 80%. This is a basket of bonds. Okay, like bonds are not supposed to do this. And I said, look, when that thing's above 100, and the price of iron in Qingdao province, I probably said it wrong, but it's iron ore 62 fines or whatever. When that's above 100, that's when they're not crushing property anymore. And so we're back past those two numbers. They're both past 100. And I think there's really, now we're seeing the policy around people being able to move around, transportation, consumption has all been relaxed. Everyone got sick, so they're still dealing with the sickness. And then there's a huge question about how much inflationary consumption and investment demand there's on the other side of that, and how long it'll take to get there. Is it 1 month? Is it 2 months? Is it 6 months? But you have to be kind of thinking about inflation, at least from China, in the second half of next year for sure, and probably in the first half. And then the question is just how much tightening we're getting. How does the curve look? And the Fed is kind of pricing in perfection right now, where it's going to tighten, and then get to ease out as the economy runs off all this inflation. And if China really has stimulation on top of the demand that you can have when people aren't just being locked in their homes or whatever, that could be really inflationary in a way that then makes it hard for people to price in these Goldilocks interest rates. And that's what's driving, to me, the biggest thing. So it's actually pretty simple. People ask you for indicators, just look at the bond yield, just look at TLT, look at what's going on with bonds. And when bonds are going down, it's scary. It's not good, especially if you're in tech, any real estate, anything with a duration, which is everything right now. Rates is the key driver.
Yeah, and obviously China as well. They are sort of pegged to the US dollar. So that means as the US dollar, as they continue to tighten, that's going to have a big impact on China.
Oh, definitely. I mean, I think that's I think that's part of the reason why their property companies are in such pain, because the US started to tighten and there's this quasi peg going on, and everybody, it's managed peg, and there's this like target, and all, it's peg, right? And if we got to the point with the dollar, I think it was a month ago, where right before the big turnaround, like if you imagine another 20-30% of dollar strength to peg against the dollar, that's 20%, 30% appreciation in the middle of this big lockdown, property crackdown. That's a lot. That's going to impose pain. And I think the reason that they shifted, it's kind of to protect the numbers in a weird way. This is so conspiratorial, but it's like, look, if we like change the machine right now, and we acknowledge that there's like this COVID thing, and we like remove the pieces, then as we like inflate it again, it won't be clear like how much we just like didn't get what we thought we were going to get or whatever, in terms of property, in terms of investment, in terms of asset write-downs. And I think mostly in terms of banks, right? Because it's really, really simple historically. The banking system is the leading indicator for a financial crisis. So you would expect the banks to come under stress, and they were coming. A lot of them were coming under stress in August and September. And you had this like crazy phenomena where people were going to protest their local bank, and their like COVID health app was saying like, now you got to go to quarantine, which is like so dystopian and crazy. Like no one wants to talk about it or whatever. I'll probably get yelled at just for talking about this, but like, to me, that's a thing that when you see the confluence of those two things, you're like, wait a second, like how much is this like institutional state apparatus protecting a banking system that they're worried about like the bottom falling out of, because of the fact that everyone levered up on property that's not worth as much as they thought it was. It's pretty simple. That'll take time. That could take, like the Japan plan is to make that take 5 years, and maybe they get out of it because there's real income growth and extend and pretend. And when the US tightens and the dollar goes up, that's the thing that makes them really have to choose, because they can't extend and pretend and keep the dollar peg and keep the property companies going and do that. It's just too many things. And eventually you say, okay, we have to break that dollar peg. If you really want that, maybe that'll even be good for China in the long run. That's why I say gold in China is like the best way to play that, because you just buy gold, hedge out the dollar, short RMB, and just say, okay, I don't know where that wall of money's going, but eventually it'll end up in gold.
Yeah, is that what Japan did sort of during that period as well? Because they have quite I guess it wasn't devalued, but it was low compared to the US to what you see today. So they were almost like sort of deflating the value of their currency. Do you think that would happen for China as well, or because they're sort of doing that now, and then if they just actually let it get to the proper strength that it should be?
Well, it's a question as to strength versus depreciation. It's like the economy, the exports would suggest that you would want a higher currency, but if you actually let that currency float, a lot of the money would leave and the currency would fall. And so that's this like perpetual narrative that like is really hard to think about, for me at least. I think Japan, like I said, had the outflows that then came back to support the currency. They also plaza accords, right? This is something that China is not going to do and didn't do, where the currency was getting so strong, they had a meeting with the US and basically managed it lower. And I think that's the difference. That's what leads me to think about conflict a little bit, because Japan essentially played ball and got 20 years of deflation. China's saying like, we're not going to play ball, and like, why? And like, is that because that there's like more conflict on the line? So like, why would you negotiate this stuff that you're going to fight about in like 5 years, 10 years, 15 years anyway?
So do you think that's the way out? So I guess, yeah, as you said, that China sees itself, I guess, as a world power, and they might not be happy to do what Japan did, and I guess just slowly go sideways over the last 20 years. So do you think that that's the only way out for them personally, or do you think they can they continue to just to, I guess, keep increasing the money supply, keep increasing credit? Is that sustainable?
I mean, I think it's when you think it's like, what does the new world order actually mean, right? And how much of an overthrow of the existing institutional structure does that require? And what's the process by which you would get there? And I think a lot of it has to go through the dollar and the response of the US to Russia and SWIFT during Ukraine, that whole thing. And now Russia and China are motivated to get everyone off dollars, right? And they just went to Saudi, and Saudi's now going to price some oil in RMB. And so now you can buy some stuff in RMB. And the question is, can you get the money out? Can Sri Lanka buy Saudi oil with RMB bank accounts without getting in trouble? We don't know. Like, that's the thing. And so I bet on the West, because the West is messy and the institutional structures work. And it's like, okay, who knows if FTX was a fraud or not right now, but eventually we'll figure it out because of the like transparent process between all these like, Twitter idiots like me and the government. And, like, we'll figure it out. It might take 50 years, but we'll figure it out. And I think that that's good for markets. And I think that when you look at like Russia trying to get their money out of China for their oil, and they're like, no, you can't spend it on this, you have to spend it on this. I'm like, like, that's not what a reserve currency sounds like. The reserve currency was pounds before it was dollars, and it was, guilders and francs and Spanish pesetas and dollars or whatever, because it was mobile, because it was the thing that would move around the easiest. And so to me, that has to be a Western thing, unless there's a huge conflict that upends the world order and Russia and China are the new top dogs and the UN's a totally different entity and the US is like out of the Pacific. Right. And so that's a huge thing. That's a thing, now I'm no longer the only person talking about this, good, because I'm just a macro guy, not a politics guy. Okay. But like, to me, that's why they would not take the pain, basically. That's, to me, the reason. It's like, if you actually are shooting to like upend the whole world order, Japan wasn't. So then you go, well, why would you play ball with the US? You're just going to do the same thing you do to all these like emerging countries where you like come in with your institutions and like mess us up. Look at Russia. And it's like kind of right that, like the US isn't totally like, it's sometimes hostile to countries that are rising and attacking it or whatever, the world order. And so I just think it comes down to currency, basically, in the end. If you look at all these long-term charts of data, what you notice most specifically is that you get just huge volatility of currency, inflation, asset prices around conflict. That's the thing, because it becomes existential for the government. The government does whatever it can with the currency to get out of that system. And then you have to be like Alexander Hamilton after the revolution, that stupid to be like, okay, now we're going to pay everyone back. You just don't do that usually. And so that means that you get all this inflation, everyone gets burned out, they lose all their wealth, and then you start over again. And like, I think that that's possible in our lifetime. Yeah, I think like that's why you should buy gold, because it could be 20 years from now, 40 years from now. But like, you look at I don't want to be too conspiratorial or whatever, but like, you look at the like, I tweeted this, like, you look at the projected number of planes that they're going to have versus what the US is going to have, and you just project that out based on GDP, and it's like laughable that the US could control Taiwan in like 2120. You know what I mean? Like 100 years from now. And so it's just a backward induction game of like, okay, how does that go? And can we negotiate a peaceful rise in the meantime? That's, I'm probably ranting too much on this, but that's what I think.
Yeah, and it's interesting if we go back to what you mentioned about, I guess, after the revolution, how they want to look after people. You can say that's the same for World War II. There was massive inflation after World War II, and it was exactly the same. It was this, well, the introduction of the welfare state, especially throughout Europe, because of looking after the people who fought.
Totally. And the West went and made everyone use dollars, right? And like, that's not a surprise. And if you look at the Asian co-prosperity sphere, part of the reason Japan was able to build all this stuff was because they were invading countries and converting them into like weird local currencies that were pegged to the yen. So it's always about currency in a fun way, because the currency is where it's like paper and power and money all come into one thing. And do you trade in euros or dollars or RMB or rubles? Like, it actually really matters in the real world.
Yeah, definitely. So if we look at, you mentioned before that I think you said that China has almost doubled the money supply that the US does. Is that just domestically, or is that sort of international money supply as well?
Oh, good question. I mean, no, it's domestic money banks.
Okay.
So, I think I don't have the numbers on the top of my head, but there's probably a lot of dollars outside that system that are non-dollars, but those are all also assets with those systems too. It's not just liabilities, right? There's a lot of assets that are dollarized. My asset is your liability, that kind of thing. I think the question and like the whole Belt and Road phenomena is like, okay, not that different from Western imperialism. And I'm not saying that in a good or bad way. I'm just saying in a neutral value, like, positivist way or whatever, where it's like you trade with someone, you get them to use your currency. And then now that they're in your banking system, it's a whole trade linkage. And so I think it's reasonable for China to do that. I mean, if I was China, if you were China, you would want to do that too. You would want to pay in your own currency. Like, especially if you make more stuff than anyone else in the world, it's pretty reasonable for you to want to do that.
Yeah, definitely. Because that's what's always interested me. They've got like, I think it's the two currencies, isn't it? There's like the yuan, which is domestic, and the renminbi, which is sort of like international. So that's quite unique. So do you think that, and from my understanding, they haven't got as many, I guess, international methods for people to actually have the currency compared to the US. So there's no, like, I guess, euro dollar system, which they would probably require to have it become a world currency as well.
They definitely would need a euro dollar system. And the CNH versus CNY versus bank accounts here versus bank accounts there, like people spend their whole career on that. And it's really tough. And it's like one of those things where you learn all these abstractions in like class or jobs or whatever on the Bloomberg screen. And then you go and like try to look at the data and you're like, oh my God, like this is a liability. It's also an asset. I'm getting it from this report. This report says it's 30% more. And, I just know that there are literally some of the smartest people I know working on those problems. And that was kind of the inspiration for anyway my company or whatever, which is make that alpha portable, right? Make that information so that somebody else can figure that out. Because your questions, like, there's no one answer to your question actually of like, what's the offshore onshore? It just depends on how you count different things. And imagine, you give that answer to some, the head of Elliott or whatever, and you're like, he asks you some question like, well, it really depends, boss. And like, they don't want to hear that, right? They want they want to hear the answer. And so I think that it's that kind of like just willing to say you don't know really, which is the way out. But yeah, I think that they definitely probably want other countries using RMB, but that you have to get the money out to do that, right? So you have to be able to allow people to like have bank accounts that they do whatever they want with, and like just that's the big question.
Okay, great. So if we go back to what we talked about the property market, you're seeing that sort of they're going out of COVID now, no COVID policy, and they're also trying to not inflate the property market. They're trying to keep it stable, I guess, to prevent the uprisings from the people who would lose all their wealth, basically. Is that what you're saying?
And there's a ton of inventory. There's just an insane amount of inventory that has both been built and in the process of getting built. And if that inventory doesn't get built, it's obviously a loss because you bought a bunch of concrete and you made a thing with it, and now you bulldozed the thing and it falls to the ground. You're like, well, I guess I lost the money. If you make it and finish it, you can find someone to lend someone money to own it for a little while. You can smooth that out, and it's a lot easier to extend and pretend or say no, it's still 10K RMB a square foot or whatever. That process, right, of smoothing out all the stuff that got built that no longer would have gotten finished if the funding market said, hey, now I don't believe you anymore, pay up. They're trying to paper that over by saying we're going to finish all the stuff that's in process and roll the companies into sub companies, and then do the rework that basically happens in every financial system ever. And the weird thing is that I mean, maybe I'm behind, but like we still don't know what's going to happen with Evergrande paper. We still don't even know, like that's been 2 years almost now of this company's dead. They have $100 billion of cash outstanding or whatever, and nobody knows who's going to take what loss. And like, oh, we'll just kick the can, and then it's Longfor, and then it's Vanke, and then it's this, and then it's that, and then it's all these really big companies that are now trillions of dollars of assets that are like just in question. And if you look at the dollar assets, they're all trading at 10 cents or 30 cents or 70 cents or whatever. And the local ones are trading at 90 cents and 80 cents, but some of them are going down too. And so there's two questions that come about from this. One, like eventually someone has to take a loss, right? And that process will kick off recapitalizations of banks and, banks eating other banks. That's a political process. It's not an easy process to do. So one, that needs to happen. And two, if you stop building infinite amounts of buildings, what happens to GDP? Like, it's not just going to go from 6 to 5, it's going to go to 2 to 1, maybe negative, because that huge part of your economy that was investing, building, you're going to turn off. And from a growth perspective, growth is the change, growth is the increase. So you're saying, look, we went up, 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 up. Now we're just going to do the same thing we did and stop doing it. Boom, that's deep, like not only deflation, it's like recessionary, it's like contractionary. And then you have your 6%, 5% promise. So that's the question is, can you clean up the banks and bail out the debt holders and get the stuff fixed and keep your promises on income growth and not have these like billionaire tycoons who siphoned out all this money get off scot-free? We had the same problem in 2008. So it's not a new problem.
Yeah, it's going to be fascinating to see what happens. So I guess if we go to the West, we've talked about before how tightening interest rates, how that's impacting, I guess, with QT, you could say the money supply in the US as well might not be changing as much as they think. So what are your thoughts on, you mentioned before as well that it might not be a perfect landing as the Fed want. What are your thoughts on sort of the potential for where that could go, and I guess what could happen to the economy in the next 6, 12, 20, 24 months?
So there are two risks you have to really worry about if you're in the West and you're worried about rates and asset prices. One is just services inflation. Labor markets are not yet that they're still pretty tight. They're not weak. They're not easy. So incomes are still growing. So you're going to have some organic inflation there. And then two, oil went up a bunch because of Ukraine, and then it went down a bunch because Ukraine was kind of, put under some control, and the Europeans got enough energy to maybe make it through the winter. And now we're on the other end of that, where it's like, okay, maybe the Europeans need more energy for the winter, and maybe the conflict in Ukraine gets worse. And to me, that's just super bullish on energy, always. Sometimes even just in a short term, but that is inflationary, right? It's like that thing of gasoline goes from $2 to like $6 or $7 or whatever the numbers are. And everybody feels that pain. Even when it goes back down to 2, you remember that pain, you feel that pain. So we just got a big benefit from energy falling. That's deflationary. That's going to help the Fed. And that makes it look like, hey, maybe we'll get back to 2% soon. But if we have this income growth and we don't have a recession and China wakes up, we're going to have 3% inflation, we're going to have 4% inflation for longer than people think. And, the bond yield is trading out another 150 basis points of easing after the next year of tightening or the next 6 months of tightening, which is totally Goldilocks. So, it's like there's a weird thing. We're getting conflict drives oil drives energy drives inflation drives monetary policy drives bonds drive your stocks, right? And so it's all just a bet on that weird thing that we have no control over, right? Which is fun. That's what makes it fun.
Yeah, it's crazy to think. So the opening up of China will have a big impact on, I guess, oil. You're thinking, because I guess there's that thought that we've seen the worst of this energy price increase due to Ukraine and Russia. You think there could be sort of reversion in that trend?
I think of it more than just oil, like just everything, like consumption. Like, people are no longer sitting at home and not moving around. It's like that experience of during COVID in the West lockdowns, when you realize like how much of your daily like expense was just moving from place to place and eating lunch on the way to a meeting or whatever it is. And when you don't have that, you're like, oh man, I got like 30% of my income back. That's great. And so that's a huge amount of spend that just goes out of the economy. I think, to how much, obviously China's a big marginal demand of oil. So that's going to affect oil in that sense of like, if there's a ton of transportation demand, a ton of gasoline, ton of kerosene, all that stuff. But I think of it way more. I mean, they also consume a ton of energy just in industrial processes as feedstock, as energy, as heating, stuff, that kind of heating industrial processes, a lot of mining, all that stuff. So long-winded way of saying, like, it's the engine, right? You start that engine, the engine consumes. And then there's the question of how much of that consumption, and it's less of energy than it is of, I don't know, iron probably, is connected to building buildings, right? And you'd think, okay, well, you don't need as many buildings if people are moving around again to get GDP going. And that's energy, right? That's not iron. It's some copper, but it's, mostly energy and food.
Yeah, makes sense. So you mentioned before as well that you think potentially, buying gold and non-US denominated currencies could be a potential, uh, you know, good invest or trade in the next 12 months or whatever. Are there any other sort of assets that you're thinking about as well that you're looking at closely at the moment that you think could perform well or poorly?
I think inflation-linked bonds are always interesting. Let me just pull up like what they're trading at, because it's always, you want to make sure tips are trading at 107. You get kind of some benefit if we get easier because interest rates go down and bonds go up. And you get some benefit if people discount more inflation and these things go up relative to bonds. I still think bonds are not a great buy. Like I wouldn't buy bonds right now. I'd probably be selling bonds in the long term. And so it's hard because that means you're bearish on duration, you're bearish on everything kind of in a weird way. Vol looks kind of cheap, but I think we can muddle along with stocks for a while. I'm not a really great stocks person. And then dollar, like I think that that's kind of the hidden secret of this like gold in China or gold in dollars trade, which is just go long dollars. Like if you're worried about this tightening, it's just a dollar trade, and that also means cash, but it means get out of leverage that gets really hosed when the dollar goes up. Because if we get more energy, we're going to get more tightening. Powell's going to go to 6 if he has to. Bonds go to 5.5 or whatever, and that's like murder for anything with like a 30-year duration on it or whatever. So just have some protection against that. And like it's kind of an abstract thing, but it's however you have it in your life. Some people have real estate, some people have a business, some people have a portfolio, some people trade crypto, whatever it is. But it's just like they're not disconnected. Like when you see inflation, you should expect tightening. And that means, oh my God, asset prices, how can I get away from just getting totally hit over the head on that?
Yeah, and I guess that would go to other emerging markets as well. They're going to be really impacted by the continued tightening of the Fed.
Yeah, anyone who's short dollars, right? And that's the classic EM thing. It's like you can't issue currency in your own, you can't issue debt in your own currency, so you issue in dollars. And then the Fed goes and tightens, and all of a sudden dollars go 30, 40%, right? And just people in the West, people in America in particular, just have no empathy for what it's like to be short dollars. Because it's like literally the most painful thing in the universe, because your interest rates are going up and your debt level is going up, and all these things are going up at the same time. And you didn't do anything. You're just sitting there hanging out, running your business, and you happen to borrow in dollars, and now you're screwed. And like that is just such a horrific trade for the people on the other side of that. And it's such a privilege to be in the US and American, frankly. And Euro has a little bit of this, Japan has a little bit of this, Swissy has this too. But like where when things get bad, people want your currency. And that means that if you have cash, everything gets cheaper.
Yeah, interesting. And how would this impact sort of your thoughts on, I guess, asset allocation? Because, if you look at the past 20 years, it's been, or I guess you could say 14 years, it's been very good to be quite heavy in equities, you could say private equity as well. That has really benefited. So what do you think is going to, how is this going to impact, I guess, allocation?
Well, full disclosure, I used to raise a fund to try to help people, hedge this stuff or whatever. And the reason I say that is because I was always up against implicitly, I love this guy, he's a great investor, but the Dale Swinson model of Yale, which was like get out of liquids and go into a liquid long-term private equity real estate venture. And he was right in 1980 for sure, because interest rates were way up here, and probably right in 1990 and right in 2000. And then a bunch of, really great investors, but kind of piled into that trade in the last 10 years. And how much of that was based on long duration, 0% interest rates, like a ton, right? And so that makes sense. That's what the Fed was trying to do, push people to the risk curve, get them into venture, get them into real estate, get them into private equity. But the issue is that, you create leverage, you create a lot of dependency on rates in your portfolio. And so it's mostly just understanding that as that cycle unwinds, it's not just that interest rates are higher and asset prices are lower. It's that the people who are usually providing capital to those markets are actively in pain now, and they can't make as much, allocations, and the process is harder, and they're getting questions from their LPs, and maybe their LPs are, some regional university that like made too many promises, and now they got to go talk to the bank about how they're going to fill all these like, capital calls or whatever. And that just makes the business slower. And so I think to some extent that's good, because you don't want everything in 50-year duration assets. And I think it's good to get some focus on things that generate cash and returns for sure. But I also think it's an amazing, amazing privilege to live in that 0% interest rate world. And there's a lot of arguments that we need a lower long-term interest rate anyway. And so maybe the market's right, Fed goes to 4 or 5, but the long-term rate is like 2.5 or something, and we get back to that world. I'm an entrepreneur. That'd be great for me, man. Equity asset prices going up by 3x, I'll take it. I just see that trade, and then I go, oh man, I'm also raising capital or whatever. That's going to be painful. Got to time that right. Like watch out for those tightening cycles.
Yeah, and you could say it also, like I guess you could say PE's become a bit of a crowded trade as well. So it's not, you might have to settle for not as good investments, and that's really when you'll feel the pain when interest rates go up and they might not be able to survive for those companies.
Yeah, and I'm not a PE guy. Like I don't have a lot of PE alpha. I don't have any PE alpha, right? I just know that they add leverage to companies, and then a lot of times you get benefits from not paying taxes, and that's a pretty good trade. So it should work, especially if you can eke out operational efficiencies for sure. but just the leverage, right? Leverage. As interest rates go up, if you're a person who studies macro history, that's just the way the Fed works. Like higher interest rates kill the weak part of the financial system, then they ease, and then we start the process all over again.
Yeah, it makes sense. So, Alex, thanks so much for your time today. I really appreciate it. So, I guess my last question is, what is one message you'd like people to take away from our conversation?
Oh, I think just that I can maybe be called a lateral thinker or whatever, but that there's a lot of things that people don't feel like they should have an opinion on, like macro or whatever. And I think that's kind of wrong, not because you should feel entitled to a macro opinion, but because you get affected by a macro opinion, meaning like what Jay Powell thinks is going to affect your home price. It's going to affect how much your kids' college, fund and cost is at the same time or whatever, how much your pension fund. And so like I think we should talk more about this stuff, even if I'm not necessarily the best person to talk about this stuff, but just like, help people like connect a little bit to like, hey, monetary policy is a gigantic thing in your life that most people like, there's one class on it maybe, and if they take economics or whatever, like, oh, monetary policy, but it's like, no, man, like gigantic changes in people's lives. I was a Lehman guy, right? Like happen because of these things that are out of your control. So it pays to just like pay attention to them and like be curious about them, and just then know that you're never going to be perfect at them because nothing's perfect, but it helps you when all of a sudden energy prices go up a ton and the Fed starts talking about tightening. You're not like 6 months behind that, even if you're just trying to refi your home, right? All these people, who have these adjustable rate mortgages just learned what that means. And so they're, those people have rate exposure. And I think there's a lot of economists in the 90s or whatever who talked about helping people diversify this. Then we had the CDO financial crisis. But long term, that makes sense. It's for people to be able to hedge out these big macro risks, right? Hedge out like a blow up in China, hedge out a big inflationary thing, hedge out a war in Ukraine. Like eventually, like 100 years from now, we should hope that we can do that stuff. So anyway, I just love that theme, and we'll babble about it to whoever lets me.
Yeah, it makes sense. And one thing I've noticed is everyone thinks, and this might just be a bit of a generalization, that they're in a vacuum. So you can say the US think they're in a vacuum, UK, I've been between the UK and Australia, and they're all talking about the same thing and they're all blaming the same people. It's like, hang on, we live in this like very complex world where what happens on the other side of the world is literally the butterfly effect and it impacts everyone. Whereas I feel like that's really hard for some people to comprehend because it's not what they see every day.
Totally. And Australians get that problem more than anyone, right? Because you're sitting between both and being like, oh my God.
Yeah, exactly. Yeah, Alex, thanks again for your time. So, if anyone wants to find more about your work, I know you have a Substack. If you want to talk about more about that, and you've already mentioned Rose AI, but I'm not sure if you want to talk about that as well.
Yeah, I think the easiest way to find me is AB Campbell at Twitter,
Yeah.
or at AB Campbell on Twitter. And my Substack's linked there. It's Campbell Ramble at substack.com. Kind of a self joke because I'm a rambler sometimes. But the intent is to be interesting and slightly self-deprecating. So yeah.
Yeah, awesome. I'll put that in the description below. But Alex, thanks again.
Awesome.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.